Fantastic. Well, thank you, everyone. What a great session there from Eli and David Olson. Fascinating discussion. My name is Matt Hatch. As Paul said, I am responsible for FinTech at EY, at least across the Americas, not globally. But I'm joined here today by Guido and Megan, who had asked to quickly introduce themselves and offer some initial reactions on the commentary we just had. I will say from my perspective, it was hard to focus after the initial high school analogy for FinTech as a father of two daughters, but I'm working on it. So thank you, Guido, Megan. Megan, can I ask you just to quickly introduce yourself and maybe offer a few comments and reflections?
Sure, great to be here. Thank you so much for having me. I'm Megan Knab. I'm a product manager at DriveWealth. DriveWealth is a fully licensed carrying broker, stockbroker, 32 positions on the New York Stock Exchange. I personally have been working in crypto accounting tax for about 4 years. Was great to hear more about, as somebody who works for an institution that's looking to enter the crypto space, really interested to hear the sort of takes from David on institutional adoption, and excited to talk more about the retail revolution.
And Guido.
Thank you, Matt. Good morning and good afternoon, everybody. I'm Guido Molinari. I'm the managing partner at Prysm Group. We are an economic consulting firm specialized in blockchain digital assets. We actually have been working with some of the names that came up earlier in the session, like PayPal and Salesforce and other large institutions. And I'm really excited about the conversation today because we think that institutional adoption is going to be key for then eventually having mainstream adoption for digital assets globally.
Well, that's great. Yeah, appreciate that. Yeah, I appreciated hearing the background there from David. It's always fun to hear someone that spent a lot of time in traditional financial services, and as they've reflected on this new paradigm that we're in and going forward, and the technology that's really driving new products rather than trying to build technology to fit legacy products. And I think that really came out with how David's speaking about what they're up to and their ambitions, which are impressive. His point on, is it happening? Yes, it is. I think is very clear to everyone, certainly in this summit here the last couple of days and a lot of the dialogue that we're having. Guido, what, because I'm looking at you here, what are you working on these days that relates to some of the conversation we just had?
Yeah, absolutely. So, the one thing that, was sort of mentioned is that, institutions are looking at the assets, they're interested, but they still have a hard time understanding what is the actual fundamental value of each asset, right? How do you actually measure that if I were to deploy, substantial capital, how do I allocate it? And, what is sort of the DCF? This is a question we've been asked. What is the DCF framework for looking at blockchain and especially digital asset? Because clearly you don't have cash flows in crypto, right? And I'm actually quite excited because the Wharton School is going to be launching an executive education program later this year. And part of the program would be actually to present a framework to how to value the fundamentals of digital asset. And so trying to think about how do I look at it and how do I compare different digital assets so that large institutions can actually have a framework that is shared among them in the same way that, you have DCF in, traditional financial services when you look at, traditional companies. So that's something I'm very excited about and looking forward to. And I think it's going to help a lot, again, people that might have been on sort of the fence so far to say, okay, I actually now understand how I can value these assets and how, confidently I can deploy capital to support the growth of the crypto market, which, we all know it's going to continue.
Yeah, that's a great perspective. Megan, what about you? What are you thinking as you look forward? What are you most excited about, either topics you've heard on this last discussion or this week?
Yes, so having been on Wall Street for the past year and a half or so, it's been an extremely exciting time, especially working for a retail broker with all the, volume in the market, especially, sort of more recently with Wall Street Bets, GameStop short squeeze. I think that it's exciting to see retail really pushing these more traditional financial institutions to developing products that they want. It's a smart idea for institutions. Investing is a sticky product, and especially crypto trading is a sticky product. I think the challenge, and I'm excited to hear what everybody else on the panel throughout the day has to say, is how do we think about building these products in a way as a large institution that maintains the sort of integrity and quality of the ethos of public chain environments.
Totally agree. It seems like we're at a bit of a tipping point here. Certainly a few things to come in terms of regulation, as was commented on, such as with ETFs. But an exciting time nonetheless. Wasim, I'm going to hand it back to you, and we'll be back with you after the next session.
Thanks, Matt. All right, everyone. Now it's time for Bitcoin 201, a technical deep dive into Bitcoin with EY Blockchain Analyzer, Explorer, and Visualizer with Brian. Brian, take it away.
Thank you, Wasim. Let me see if I can start sharing my screen, but just bear with me. There we go. Hopefully that looks about right to everybody, I would hope. Thank you, Wasim. I appreciate you handing it off to me. And as you're speaking, it made me realize how incredibly long the title to this presentation is. So I appreciate you handing it off, and welcome to Bitcoin 201, a course at which we'll take a look into the interworkings of the Bitcoin protocol. So a little bit different than I think some of the other presentations that we've had before, but hopefully it will give a good level of insight to those who are watching. So what we're going to go over today, see if I switch my slides here accurately. There we go. First off, as any good Bitcoin 200 level course would be, we'll start off with a 101 refresh, just kind of going over some of the basic principles of Bitcoin, which I'm sure will be kind of a refresher course for everybody who's listening here. And then we're really going to jump into two main topics that we'll spend the most of the time on: understanding of the digital signature that gets utilized on the network, and the signing of transactions on the network. So using an actual transaction that's occurred and illustrating how the digital signature process occurs. Finally, we'll discuss a bit of the pitfalls that we've seen within some of the deployments of these signature processes. Nothing too flawed there, but certainly something to be aware of as we go on. But first, let me introduce myself. My name is Brian Attardi. I work with digital assets and in the assurance innovation practice. So essentially designing and developing tools for the audit and assurance team. I work within our digital asset research center, and we develop tools for our client needs to prove out proof of ownership, proof of control, and so on for a number of different crypto assets in our clients' portfolios. So things like the digital signature verifications that we do, things like the address generation programs, hashing calculators, manual header calculations, manual being the word there, which is exhausting process, but we'll touch on that a little bit as we go through this deck as well. And before we jump into the refresh, just a little bit of marketing. If you get some time during the presentation, we'll be leveraging the blockchain analyzer, Explorer, and Visualizer for the screenshots and the captures. As Paul had mentioned earlier in the, I believe, day one, it's a fantastic tool, free to use, and would highly suggest taking a look, especially taking a look at some of the more interesting transactions that occur on network when kind of whales transact with one another, as a great Neo4j visualizer to be able to see exactly how transactions are connected to one another. And that'll be another piece that we show on the slides here today, but definitely check it out. Yeah, let's jump right into Bitcoin 101 refresh. So we'll start off talking about something that I'm sure everybody's all too familiar with exactly how we've gotten here. The Bitcoin white paper being written by Satoshi Nakamoto in 2008, being distributed to the public in 2009. And while not too much is known about Satoshi, what's interesting is a lot of the conversation around the creation of Bitcoin took place on forums. So it's very interesting to kind of look back and see the history of things as it's progressed to where we are now. And interestingly, some of the issues that they were talking about then were problematic then and are problematic now. Everything from scaling to mitigation strategies for energy consumption, which I know has been pretty prevalent in the media as of late, but we have been able to kind of track some of those topics, and sometimes they even yield really strong answers for us moving into the future. But we were able to see the creation of this process play out day to day. And so the second person ever run a node was Hal Finney, who simply wrote Running Bitcoin in January 10th, 2009. And we'll talk about some of the terms at which are pretty commonly used in network. We talk about Bitcoin as a capital B, talking about the peer-to-peer network and the protocol. And then we talk about the lowercase b, representing a unit of account, the currency, something like the dollar or the euro or something along those lines. And then if you ever see capital B, capital C, I wouldn't say run away from that person, but at least turn and do a light jog, as certainly not an industry standard term that we see on the regular. So definitely important to keep that in mind. Now, where have we gotten with Bitcoin since its inception? Has been very interesting, as we've seen a number of, there you go, a number of clones from the protocol standpoint, some clones being just forks with a different philosophy in mind, but to keep just to see kind of a network overview. And of course, being mindful that these numbers were pulled April and not May, definitely have a significant difference. So you'll have to bear with some margin of error within these numbers. But essentially taking a look at how large of a market cap, all of the Bitcoin and Bitcoin versioning, and painting with broad strokes there, as well as Litecoin, Dogecoin, Monero, and Zcash to their own right have their own purposes that they're fulfilling, represent about $1.251 trillion. And so it's a huge advance from what was just a conversation in a chat group to exactly now. And it's been very interesting to see some of the evolutions that have occurred, especially with these different coins that we have here, where coins like Monero and Zcash went to tackle privacy concerns that they, feel Bitcoin hasn't been addressing too well. But, things like Litecoin, changing some of the scripting algorithms, or changing the hashing algorithms to script, excuse me. And then things like Dogecoin, as everybody is extraordinarily aware of at this point, being one of the most highly transacted currencies since its inception, has very interesting technical features. In primarily, it utilizes something called an auxiliary proof of work, which means it doesn't actually have people mining its coin directly. It has people who are mining Litecoin who are rewarded with Dogecoin when they do not successfully mine Litecoin, or when they do, but subvert the difficulty level for both tokens. They get kind of both. Just a very interesting approach to some of the conversation around the energy waste that we hear within networks. The auxiliary proof of work was something that was talked about some time ago in the actually Bitcoin talk forums, and we actually see it play out these days as something that has hit the news as drastically as Dogecoin. Since Bitcoin's existence, we've seen a number of notable transactions, and I think landmarks within the digital currency community. Some of those being the first transaction between people on January 1st, 2009. Block 170 occurred. I believe it was Block 170, where Satoshi Nakamoto sent 50 BTC to Hal Finney. In one of the few transactions we've seen and been able to monitor from Satoshi's wallets that we know he actually transacted in. But an interesting one as real digital currency was exchanging hands for the first time, or real digital currency for Bitcoin was exchanging hands. And then we have another interesting one, which was the first Bitcoin transaction for fiat, which occurred October 12, 2009. And that's where 5,050 BTC was exchanged for $5.02 on PayPal. And very interesting to take a look at a transaction such as this, as it's being one of the first transactions. But if you take a look to the right here, and I'm not sure how clear we can see it, but this kind of flowering approach illustrates all of the inputs that had to have occurred for the transaction to be processed. So I think we've become fairly callous when we see 100 Bitcoin or 1,000 Bitcoin being transacted from one party to the other. But seeing from network genesis to now how those those bundling of values had to occur at some point to get that outlier, that little one all the way to the right, as being the output for that transaction. And then finally, transaction I think many are familiar with at this point, occurred on May 22nd, 2010, where Laszlo Hanyek, and I'm sure I brutalized that last name, so apologies, bought 2 Papa John's pizzas for about 10,000 Bitcoin. Process now known as Bitcoin Pizza Day. And as we've all had, some of us may have had Papa John's pizza, about 2 of those cost roughly $561 million, I think is a fair rate of exchange. So not too much has changed since 2010. Zoom out a little bit about blockchain, about the blockchain that Bitcoin is based on in general. Take a look at some of the structures at which we see regularly. In particular, what this allows us to do is illustrate, back in the day when we were talking about blockchains, one of the things that people would always traditionally say is, well, one block is linked to the other block and so on and so forth. And really that kind of surface level explanation I think was great for the time, but to actually dig in and understand what that means, we can take a look at a graphic such as this, where we could see that the header of the block is the goal of most miners to get to. Really, it has to subvert the difficulty level for the particular protocol it's mining on. And so that equation is based off of 6 pieces of information. The version, the date, the difficulty are all pretty well known. And that merges with the Merkle root, which depending upon where you are would be the bundling of those transactions or the transactions representation. And then the last piece being the previous block header. And so all of those pieces of information are involved in the calculation of the block header. And what miners will do is they'll adjust the nonce as a dial back and forth to try to subvert the difficulty level. And if they are able to do that, they are rewarded with Bitcoin, Litecoin, Dogecoin, etc. But that is their goal and their target as part of the mining process. And so it certainly illustrates a little bit about what we actually mean when we say that there's previous bits of the other block involved. It's directly linked to the block header calculations. So talking about the transactions and how they're represented, it's also helpful to think of how the transactions are actually working. For that, we can take a look at a graphic we were able to pull from the Explorer and Visualizer. Save for the yellow line, that's something I added in, but this transaction did take place on network. And it's important to think of how a transaction is actually getting processed. So as a transaction is being approached, there are outputs that have to be had. So where funds need to progress to. And the only way that those funds progress to those pieces is by reaching back into the parking space of previous unspent transaction outputs. And something that people may have heard of before, UTXO model transaction basis. This is what it kind of means, is that every transaction that has inputs, which all of them do, has to reach back to a previous output. Of course, I'm ignoring mining for just a moment here, and we're just talking about kind of base transactions. And so this kind of reach backward to a previous address and then asking the funds to move into this current transaction to progress to other unspent transaction outputs, there requires a level of validation that needs to occur to prove that the new input is allowed to be moved from the old output. And so that is the lock and key mechanism that occurs with every transaction that we process on network. So if transaction D79, which is the blue circle, wants to put funds into 6RY and TE2, it needs to reach back to FYQ, prove it can move its funds by illustration of the digital signature, unlock the funds and relocate them to the new parking spaces and new owners, if it were. So that digital signature process is tremendously important as we look at the mechanism of movement. And so it's really important to also understand the signature at its core and why we can use it and what basis we have to know it is utilized successfully and accurately. And to do that, we can take a look at the the curve that Bitcoin is built atop of, which is the SEC P256K1 curve, or SECP. Some may have heard of it that way, but it is defined by y squared equals x cubed plus 7, which for those who have had algebra teachers as strict as mine may have been beaten into your head. Y equals mx plus b. That's the slope of a line. There's some similarities there, at which it is a line definition. And so we can illustrate this curve to the right here, and it looks very nice. This is not a truly accurate representation, as this is kind of shown over real numbers, and the real curve is a finite field of the coin's prime order, which means that instead of a very nice curve sweeping lines like this, it's more of a spread out mess of dots everywhere. And so this is way easier to digest, as the properties are similar between the two representations. So you'll see this curve represented in a lot of different places. But this is the main mechanism at which allows us to generate the public and private key cryptography that is so vital to the cryptocurrency and cryptocurrency in general. Whatever coin you're utilizing utilizes this to a certain degree. And so, when we're going to create our public and private keys, our private keys are certainly a truly random number, less than 2 to the power of 256 in this instance. But to create the public key, we need to take that private key and multiply by the generator point, which is listed here. Quite easy to memorize, as you can tell. And the equation for such may beg the question, why doesn't somebody just take your public key and your known generator point and divide and come up with your private key? Well, within this seemingly innocuous multiplication equation is actually a lot of a whole different world of mathematics. It utilizes point addition and point multiplication to actually execute math on a curve. And so equations like this, while look very easy to digest, are something called trapdoor equations, meaning that they can only progress in one direction and not the other. And so that is really the core process that allows us to share readily available information, such as people's public keys, and we'll show some of that, and not allow us to work backwards, obtain their private key, and then able to spend that person's funds. So we'll take a look into the actual digital signature mechanism that occurs to enable us unlocking funds and progressing them across. And for that, Bitcoin uses the elliptic curve digital signature algorithm, or ECDSA. Based on digital signature algorithm that developed in '92, and it supplemented somebody named Klaus Schnorr's patented process, which has since expired and entered into the public domain for those who keep up with network innovations and have heard of Schnorr signatures. This is the up and coming math that will kind of carry the network forward, in my opinion, of course. But I think people are signaling right now on network to adopt the first step to bring us to Schnorr signatures. But we can back up a little bit and still stick on ECDSA. And something to take away from this is it is not encryption or decryption. While public-private key cryptography can be utilized for that, it is not in this instance. The ECDSA process to help digest can be thought of as occurring within two fashions. One at which an algorithm that creates a digital signature utilizing a private key and a message, and an algorithm that validates a digital signature, given a message, a digital signature, and the public key. Now, when we work with our clients in assurance and audit, the digital signature is a way that we prove ownership. And so in order to do that, we will have a message being a text-based message that people can sign and give us back and validate that they do indeed have control. However, it's important to keep in mind that as the network is running, the message, air quotes, in this stage is the transactional data. So it's the information that is going to be progressed from one location to the other. And again, we'll show some of that within the actual network execution in a couple steps here. But we could take a look at these actual equations to show the math behind And don't worry, I won't bore anybody with going into the nuance of some of these, as it is really complex and I'm not a cryptographer. But it is great to take a look at some of the variables that get placed into these equations. And so things to note in this is that in the creation of the digital signature, we can see that the private key, or lowercase pk, plays a role, as well as k, which is a random private key. And we'll touch base on why that's important a little bit later. But that private key is in the creation of the digital signature. In the validation equation to the right, however, we can see that there is no private key that's involved here. It's just the public key. And you'll have to take my word on this, but these equations equal one another to a certain mathematical degree, at which we can trust the output of one to suggest that the private key is the only possible way they would be able to come up with that particular digital signature. And so that becomes extraordinarily important when we're progressing transactions from one location to the other, as we want to make sure that the holder of that private key is indeed the actual holder. And so we can take a look at how these messages and these public keys and signatures play together when we talk about signing of transactions. And to do that, we'll take a look at the raw transactional data. Actually, the raw transactional data from the pizza transaction that we talked about previously. As you can see, it's pretty straightforward. So not much to do here, but any questions, you can send them. But really, you can start to pull some bits of information, as meaningless as this may seem at first. Some of the delimiters that may be playing a role, a lot of Fs, a lot of zeros, and so on. And we can digest this in a little bit more formalized capacity, such as this. So this is that particular transaction that we were talking about in a little more organized fashion. And we can see that as this transaction was executed, 10,000 Bitcoin went in, 5,777 went to one address, and 4,223 went to another address. So while we're digesting just this piece, it is important to know that there is other pieces that are going on, which is, again, that kind of reach backwards for the outputs of a previous transaction. And so that will be a step within our process. As we prove that the funds were allowed to be entered into this equation, we will illustrate the public key, the signature, and the message required to move these funds. Now, two of these pieces of information are pretty readily available, the public key and the signature. And the third is going to require a little bit of work, but we'll get there. And it's important to know that the message that we're going to piece together is going to be another 3 pieces of information, and we'll get there. The first piece of information, however, is quite easily found. We could refer back to the get raw transaction string that we showed previously. Again, those Fs delimiting are able to be a little bit of a road mark, and we can back that all the way up to obtain what is the first piece of 3 pieces of information that we need, the public key. It's important, I think, that people realize that the public key is accessible, even if it's an XPub, which some may be familiar with from HD wallet structures. But the public key being an internal mechanism that is required for us to do these validation steps is something that can be accessible. Not saying anybody should go and start publicizing their public keys, of course, but it is something that is on network. And so we can actually obtain this public key from another location as well within the script sig, but we'll show that step as we reach for the signature. Signature being the sign off that this is a good transaction that can be executed. To get the signature, we're going to take a look at the script sig. The script sig sits within the JSON representation of transactional data that you may see on network. And I would suggest it on the blockchain.ey.com Explorer. There's a little JSON on the raw transactional data, and it will display quite similarly to show the raw information. And so in case anybody wants to lull themselves to sleep, it's a great place to start. But for those who are really trying to dig in and get a view of how all these mechanisms are at play, it's also a great way to take a look. And so we can extract this entire script sig from this transaction, and we can show that there are actually two pieces of information that we can garner from it. Again, once you start to get a little bit of familiarity with how the data structure works, you can start to see that 48 could be the byte length, as well as kind of the 0141 can dictate what the next set of characters are, and using that as kind of, road marks for extracting of these bits of meaningful information. And so here we'll kind of split the two pieces that we see here. We have the signature on the left and the public key on the right. Again, we already had the public key, but it's great to just know that it's available kind of readily. That will be our second piece. Now, the third piece, again, being the bit of a more tricky version, is how do we put together a message that validates that funds can move and into the new transaction. So we can refer back to the graphic that we showed previously. Everything that we've done so far, we've been able to extract from the current transaction, but we still need to do the construction that validates that these funds can be moved from one location to another. And so this is where, for those who may have heard of it before, you get the pseudonymous nature of Bitcoin, where you can say that outputs from a transaction can be linked to inputs of another transaction. Now, the inputs to the outputs, the other side of that coin, is way more difficult to do, especially as transactions are bundled together. So that's the bit more of the anonymous nature of it. Of course, I'm leaving off things like mixers and ways at which people can try to subvert this type of monitoring on network through kind of extraneous means, but you can get a sense of when people say pseudonymous exactly what they mean. If you knew the owner of one output for a transaction, then you know the owner of the input of another transaction. You just don't know where the funds went afterwards. Anyway, that's a sidebar completely. But what we want to do here is reach backwards for this FYQ address and validate the process can move into these new locations. So this is a bit of a mess, I know. As these are three parts of information that we're going to need to put together, an additional rule of three, I suppose, would be similar to the three that we're already working on. But we can extract kind of two pieces of information again from the get raw transaction, and we'll have to replace the middle point here with the previous transaction information. So part one, or actually part three, is quite easy. It is the output of the transaction, the two locations at which it's migrating to. The input, or for part one, however, is a little bit more interesting, as it contains the transaction hash from where we're spending in something called little endian. Endian formatting is a bit of a interesting process. It's something that occurs within the Bitcoin network where the digestion of the data is done in big endian, but the representation is done in little endian. I think I got that right. It might have been switched. But endian formatting is borrowed from Gulliver's Travels, at which there are two kingdoms that decide which side of an egg they should eat first, the little side or the big side. And if that's confusing, that's fair, and it's permeated throughout the network. So formatting is extraordinarily important if anybody is going to try to replicate some of this information. If anyone is going to try to build their own manual header calculations, making sure that the byte order is indeed, whether it be little endian or big endian, depending upon the equations. So something to keep in mind. Finally, back to this, we're going to be reaching into that second piece of information. That second piece of information is going to be retrieved, like I had mentioned, the other transaction. Here, we're going to take a look at the script pub key. And in particular, we can talk about the ASM or assembly, and that illustrates Bitcoin's scripting language opcodes. And for those who are familiar with computer programming, the opcode works as a push and pop code execution strategy. There's not a lot of logic there, and that's very much by design. But we can take that as the meaningful order of operations that had occurred to lock this fund where it currently is. And we'll extract that in the hex representation of that script. So we will jump into talking about the composite of all of these pieces of information, which does get a little messy. So we'll try to take our time on it. So for now, we finally have all three pieces of information. The second set of three pieces of information. We'll still have to roll everything up, but it's on its way. Part one we have, like we mentioned, is that little Indian version of the transaction. Part two is the actual transaction hash we're reaching back into, and part three being the output of the current transaction. There will still be some formatting steps we have to go through. We'll have to add the script size of 19 to part two, and we'll have to add the final opcode, sig hash all, which in its hexadecimal representation will be 100,000, and that will be tacked on to the latter end of part three. Finally, putting this all together, as Croc's putting it here, is that we need to make sure all of this is in one string. There are bits of spacing issues that you'll have to be wary of, again, in case somebody is playing along at home, to make sure that this does indeed function as intended. But this lands us to our three pieces of information, finally, at long last. The public key, the signature, and the message. Now, one more step here, of course, as there seemingly always can be, is that the message needs to be hashed. And so it's hashed in a SHA-256 hashing algorithm twice. And so that outputs a string or a hexadecimal representation of a number. And you can input all three pieces of information into a verification program. Now, unless you're really good at multiplication of these kind of numbers, you could probably do it freehand, but I would suggest utilizing something like Python or JavaScript, or even if you're running a full node, you can run your full node and input these three pieces of information, and we would expect an output of true. Now, there is absolutely zero fanfare there for all of the work that we put in. There's not even an exclamation point at the end of it if you run it through Python or JavaScript, simply the word true. I even capitalized it, but there's no fanfare there. So why do these processes? Why illustrate that this functions in this way? I think it's twofold, is that we want to know these processes internally, because it helps both our clients and our users on the EY side have a better understanding about how the internal mechanisms of this system is working. And that helps because on the more basic transactions, as this was, we didn't touch on multi-sig, we didn't touch on anything a little bit more nuanced than this. It really helps color the understanding of where the core developers may be going, where some of the issues may arise for security problems, where people are trying to build new enhancements to the network, as well as understanding about why the transaction processing, maybe the speed at which it currently is, the number of things that it needs to go through and all of that. And so it's really important that we can remember that, because it helps us kind of predict where the network is landing. And on the other side of the coin is really purely from a client perspective. We talk to clients all the time from a really large array of technological sophistication with their programs. Some are utilizing kind of the latest, greatest hardware and are able to touch their private keys quite readily, which allows them to output digital signatures, which is great, especially from an auditor's viewpoint. However, others, especially those who have been around for a significant part of time through the network, use physical distance as being a security measure. And that's great. It does make things a little bit more difficult from an audit standpoint. And so we may prove ownership in different fashions and different strategies. But it's important for the client's comfort to know that when we're requesting digital signatures, when we're talking about public keys, it is such an underlying mechanism of the network that, one, we're not undue access to any private information. There's, we certainly don't want to sit ourselves in any sort of private area and, betray any sort of trust that may yield. Everything is everything that we do is done on network so that our clients can have some faith that that exchange of information isn't going to cause any security vulnerabilities. So it's really important for us to know and for our clients to know that we're aware of how the system works and that the questions that we're looking to garner from them are meaningful and non-security risks. But that being said, there are also pitfalls. And so pitfalls are an important piece of these processes, especially as clients are finding their way onto the network, whether they be technologically sophisticated or some not so much. And the idea of where can we see flaws in some of these systems is important. And it's not a flaw in the process, because if there was ever a flaw, it's just that it relies on some human input. And that is always the weakest part of any system. And so we can look no further for that than PlayStation 3. PlayStation 3 was released in 2006 and had a 4-year run at which everything was locked down, which was great. But what they utilized was an ECDSA process that authenticated their disks. And so if you tried to play a burned video game and the disk would not function unless it could prove the digital signature on the disk, which worked very well. However, it was improperly implemented. If we think back to the equation that we kind of showed earlier for the creation of the digital signature, and listing it here below, K within this equation is a random number. It's an additional private key set that gets folded into the creation signature and is extraordinarily important because that randomness, that complete non-affiliation with your private key adds a significant level of security around the ECDSA process. And so improper implementation where the K is not random becomes problematic. And in this case, the random number generator, and I think for those who are familiar with code, who have experience with random number generators, everything from creating really poker card games to rolling of die can understand that there's a very large array of what would be considered random. Here, it was the number 4. And I think that was the number that it output every time. And while not visibly problematic, as the digital signature for the input may be different as it goes on, so you wouldn't really be able to realize it, the hackers, as I put in air quotes, because I don't know if this is technically considered hacking or not, but they were able to cross-reference the digital signatures and output the private key. Because as any elementary arithmetic view on an equation is that the more variables at which you enter that you know the value of, the easier other variables are able to be resolved. And so once you know K in this equation, once you know the random number that is always generated, we can resolve for the private key far easier. Now this has been patched, of course, and the security concerns are really gone. But when we start to see users taking control over some of their assets, of some of their digital signature processing, especially utilization of third-party libraries, utilizing less than ideal situations for developing their code base, this is always a risk. Bringing on developers who may not have that understanding of the importance of this random feature can be hugely problematic. As I mentioned, when you're building your digital signatures, if someone resolves your private key, you lose all your funds. So you really only get one good shot at that. So the best thing about some of these digital currencies is the fact that no one's really looking over your shoulder. And sometimes the worst thing is nobody's really looking over your shoulder. And that also translates into utilization of third-party tools. For those who have not played around with iancoleman.io, I highly suggest it. It's a fantastically well-maintained tool, which allows deep dives into the different Bitcoin improvement plans, allowing you to understand some of the mnemonic generations, messing around with BIPs 32, 44, 49, 84, 141, and adding. And so you can really get a sense for how private and public keys are generated. And it's a great tool to understand what's going on without having to be concerned about losing funds that do not exist at a particular private location. However, when people get too familiar with tools, they start a little bit more, their eye for security does start to drift. And in some of these cases, we had to warn, in particular for the Ian Coleman tool, was that in late 2019, somebody had copied the open source code base, which is freely available and great because we can validate and make sure that things that are occurring are not problematic for our processes or just messing with the information. And what they did was they copied it and they created another web page. The other web page was, I believe, iancoleman.to or something like that, a different extension, web extension. And then they took it one step further and bought Google search results as a sponsored search result. So when people were looking for iancoleman.io and just typed in the name, the first result was the sponsored result of the page from, I would say, a nefarious person. I think we can label them that after all of this and say that this is the problem is, that person is sitting between the data and the page now. So for those people who may have been a little bit more lackadaisical, and of course, nobody on our side had been taken advantage of, thankfully, we kind of made the messaging fairly well known. But it's important to know that, especially as people are branching into this area, that things like this can occur, and that bit of lax nature that can come with familiarity can be hugely problematic. And I think there's always going to be that easy way to make money on the internet. It's always going to be to steal, to invade, to restrict privacies, and to monitor. And I'm always reminded by a quote from Hal Finney, whose birthday had just passed and whose quote I will wrap up with. But the computer can be used as a tool to liberate and protect people rather than control them. I think the easy way is all of the steps that we talked about previously: intrusion, monitoring, etc. And the hard way to create value is the more difficult way. And it's the way I believe Bitcoin went about it. And so I think that that's going to be the one that lasts the longest. So thank you very much for joining. I believe my contact information is on the blockchain.ey.com page for the summit. Feel free to reach out to me. Happy to explain any more information here, questions, queries, or issues, or if I missed something. Learning is all part of this system, and the rabbit hole goes further down depending upon which angle you choose from. So thanks so much, Wasim, team. I think I'll throw it back to you guys.
Thanks, Brian. And now it's time for another Block Talk session with Matt, Megan, and Guido. You're free to speak.
Thank you, Wasim and Brian. Great job on that last session. Incredible discussion overall. Very, very technical, very complicated. And I think you did a great job of pulling it all together and taking everyone through it. Your enthusiasm for it is absolutely infectious. So thank you. I'd like to start with maybe just some true confessions here. So I made it till about 8:30, slide 11, felt very confident, felt smart. And then I started to question everything and what I was capable of. Brian then used a word, said, a few words, while this looks easy to digest, and I really wasn't there, it wasn't easy. But I followed along the principles behind this. I couldn't teach this class certainly, but Brian, nice work with the complicated and technical discussion. So in the spirit of true confessions there, I made it till 8:30. Guido, how about yourself? Was this all stuff that you know very well and learned a bit more, or did you struggle through some of it like I did?
So man, I don't have a technical background, but our clients are extremely technical, right? They're some of the top crypto projects in the space, and I think what Brian did, which I think is important, is show that you can, if you want, you could verify yourself, right? And I think this is a key principle of our industry, right? That things are ultimately transparent. And if I wanted, I could go with like the analyzer does make that process of verifying so much easier. And I think that's something that, it would, I think most people in the audience would really appreciate the work made by the UI team in sort of making this available. I know right now it's only available for Bitcoin guys, but if you do go on the analyzer, which I strongly invite you, you can see that other assets will be added, and so people will be able to sort of see how actually it happens on the blockchain in a facilitated way, which I think it's in the spirit of bringing this industry more accessibility to people that don't have the technical background, being able to do what Brian took us through by themselves. So very much appreciate the work.
Thanks, Guido. Megan, how about yourself?
Yeah, I mean, I think not personally being a cryptographer, all of the sort of numbers on the screen can certainly be intimidating. But it was honestly one of the best sort of reviews, both technically and historically, of the UTXO chains. I think what's interesting is that, at a high level, conceptually, you can follow it. And what makes it interesting is thinking about how we all bring our different sort of purviews. So certainly thinking about this from like a tax auditing reconciliation perspective, this stuff is actually really key to being able to understand and interpret, and then, sort of spread to the masses and entrepreneurs and investors. So complicated, but really important to understand. So appreciated it.
Yeah, I absolutely agree. Brian there towards the end asked a question and presented a topic around sort of why it matters. And the thing that strikes me, and as you just said, Megan, there's a lot of the technical details here that it's important to understand how it works. We've got a abstraction in these tools that helps us see it a little bit easier. But the transparency that this enables, this knowledge, this the open source nature of this technology to allow trust in this system is incredible, and I think is super important. And I think the other part of it also is the ecosystem that enables, right? And Guido, as you said, as you pointed to, there's a lot of tools certainly we're developing, and some that we've shown here throughout the sessions this week. And there's many other contributors to this ecosystem. It is truly a community that is collaborating on this technology. And I think that transparency and awareness of these protocols is so important. Guido, do you agree with that? You have a different view, or how do you also think about the
absolutely,
ecosystem?
Matt. And I know we're not going to be able to comment on it because it's after our last session, but I know zero knowledge proof will be presented later by our friend John Robotham, and I think that's another tool that I think people would be super interested to see actually, starting to happen in action. So the ability to know that I'm validating something on the blockchain without access to the underlying data, but knowing that the other party is not able to fudge with the data, right? And so, and if we think about an enterprise setting, that's something that could be extremely useful between, a supplier and in a corporate, or a corporate and its customers. I can verify on the blockchain without them disclosing any confidential data, but I know that the data is actually what EY or another auditor has validated. And so I think these tools coming into action will really facilitate the deployment of blockchains in the corporate settings, which we're starting to see, but even more later this year.
Yeah, that's great. I agree. The stakeholders in this ecosystem, the contributors to the technology are vast. Megan, what's your thoughts on that in terms of how this technology enables the community?
Yeah, I mean, it certainly helps to be able to speak the language of non-cryptographers, right? And so that's a good thing in terms of building out a foundation outside of, just computer science. It's interesting that you mentioned the word trust. It's true, the more transparency, the more easily verifiable these things are. Certainly agree. I think it also just builds a lot more confidence in the technology stack and everything you can build on top of it.
Yeah, I agree. A lot of, I think, important principles here that we talked through. It's also, again, as I mentioned, father of kids, to be able to remind them the importance of the math coming to life here in a lot of these examples that we went through. Certainly very complicated, as we've all discussed, and I think it helpful to see really what is behind it and what's driving some of these ESG comments I know that we've shared in the prior discussion here today around just the processing necessary to work through this. So certainly very exciting, and appreciate again Brian's very thoughtful discussion there in terms of the technology, and looking forward to our next chat here after the next session. Wasim, I'm going to hand it back to you.
Thanks, Matt. All right, folks, now it's time for our next session, how to DeFi your bank account, with Omer, Kyle, and Mark. Take it away, gents.
All right, thank you. Let me share my screen. All right, Kyle, we'll kick it to you.
Hi, everyone. Welcome to our How to DeFi Your Bank Account Masterclass. I am Kyle Kaufman, a senior manager in our Columbus, Ohio office. Yes, the title of our session today is a play on the words DeFi and defy. No, we won't make too many more jokes today. But before we start, I think we all acknowledge that this topic is better discussed over your beverage of choice. Seems like we're headed in that direction in the world today, but in the meantime, let's have some razor sharp focus as we go through the materials. Let's master things together. So the goals for today, we're going to break into 4 pieces. First, an understanding of DeFi in theory and through a series of visuals. Second, an understanding of the DeFi landscape to highlight the key protocols in the space. Third, a step-by-step tutorial of how to use the basic features of the DeFi protocols. Last but not least, a demo of our EY Smart Contract Analyzer tool to help you understand what lies beneath the hood of decentralized applications and their smart contract functions. Before we go any further, let's do a brief introduction of our other wonderful co-hosts for today. Mark, the floor is yours.
Thanks, Kyle. Hi, everybody. My name is Mark Vangeloff. I am a manager out of our Columbus, Ohio practice. I'm really grateful and honored to be here presenting to you. And I know we'll let Omer introduce himself when he brings up the smart contract analyzer. So Kyle, without further ado, I think we just get to it, right?
Yep. So the first thing you're going to notice is that Mark and Omer have beautiful DeFi beards. Mine's coming in the fall of 2021, so stay tuned. All right, without further ado, let's get into it. Step 1. Before we talk about DeFi, let's first talk about finance. In my opinion, one of the reasons it's difficult for humans to understand DeFi at this point in time is that it's difficult to understand and define finance in the first place. So if we define finance and really just kind of bucket it into it being a broad term for management, creation, and study of money and investments, we define those matters as activities associated with banking, savings accounts, leverage and debt, think borrowing and lending, capital markets and exchanges, funds, insurance, and investments. We can then split finance into 3 buckets: corporate finance, personal finance, and public finance. So when we think about for-profit entities and corporate finance, very simply, companies execute credit arrangements in the managing of their debt to properly expand operations and enhance the profitability of companies. We think about personal finance as the assessment of family needs for current and long-term financial planning through the use of savings accounts, IRAs, and 401ks. We can also think of public finance as the taxation, spending, budgeting, and debt issuance policies that affect how governments pay for services that they provide to public. So we're boxing that in. Think of that as finance. Let's now move to decentralized finance. And really, if we keep it simple, at this point in time, decentralized finance is purely replicating the pillars that we just went through in the finance world. The key piece is that instead of financial institutions acting as a mediator for financial functions, we now have code as the mediator in the form of a smart contract within a decentralized application built on top of a public blockchain. Beautiful. All right, now let's understand the benefits. First, throughout the summit, you've heard lots of discussion about the benefits of decentralization. We're not going to reharp on that now. But on that note, one thing we will say is, when else in history has it been possible for an individual or an entity to earn a yield without the assistance of a third party by simply acting as a lender or liquidity provider as a result of having an internet connection? Pretty impressive. Second, DeFi expands access to financial functions to the unbanked and underbanked simply as the result of that concept that it's accessible to anyone with an internet connection. So last but not least, we're going to dream a little bit here for a minute. I've spent my career auditing order to cash, procure to pay, treasury processes for companies. We know hundreds of billions of dollars, if not trillions of dollars, flow through supply chains and business ecosystems. Think about all the payments, rebates, incentives, even customer deposits that are conducted between manufacturers, distributors, and customers. So if we can imagine the tangible value created in these supply chains as transacted on a public blockchain and make use of the yields attainable through DeFi protocols, I personally think tangible value can be generated in these business ecosystems simply by utilizing what have historically been idle assets. I think that's where we're going. I think that's what we're building here. So before we move on, we have a chart on the screen right now as one additional quick reference point. Basically, what you can see is that $64 billion are currently deposited into DeFi protocols. And if you follow the orange line on the graph, it's had tremendous growth over the past year. Okay, we talked about finance, we mastered DeFi. Mark, for all the visual learners out there, including myself, let's break it down with some key terms and some nice visuals.
All right. Thank you, Kyle. And so before we get into it, I want to run through a couple key terms that'll keep popping up, throughout the course of this deck. And one, protocol is just a system of rules that determine how an activity is conducted, and can also be used to refer to a finance protocol itself. Second, decentralization is just the transfer of decision-making rights from a centralized authority to a community of impacted stakeholders. The wallet is just the crypto equivalent of an account at a traditional financial services institution. And yield harvesting, liquidity mining, I've seen these terms get used interchangeably. I tend to stick with yield farming or yield harvesting, but it's really just the act of depositing assets into a decentralized protocol in order to earn a yield on those assets. And what we've been seeing as the ecosystem matures is that some of these take it one step further, whereby certain protocols optimize this activity by constantly evaluating yields of other protocols and automatically reallocating investor capital. So just as Kyle really harped on understanding the finance component, I'm equally as passionate about understanding how DeFi fits into the existing architecture of the internet, right? So, you kind of have to have an idea of how the internet works to do that. So, a protocol, as we defined earlier, is just a set of instructions on how to do something. And the internet is built on protocols. These protocols provide the instructions for bits of data that they need to follow in order to be communicated from point A to point B. And protocols exist in real life as well, right? So a good example is, flying on a plane. You pack your bags, you arrive at the airport, you find your gate, you board when your group is called, you sit down in your seat, you're transported from point A to point B, you disembark, you unpack your bags, voila. But if anything in this series of steps goes wrong, you'll either will fail to arrive at your intended destination, or you arrive in an incomplete or inaccurate state. So without these protocols to follow, traveling by plane would be probably chaotic. And so the protocols that comprise the internet stack operate in a similar manner, right? They standardize the way in which data is organized, addressed, transmitted, routed, and received as it travels across the internet. And if data is introduced that doesn't abide by these protocols, the network doesn't know what to do with it, and the transaction, the communication is lost. So the visual on this slide, it's a very simple version because I'm a simple guy that likes simple visuals, shows the internet stack. And it shows, logically how the lower layers we go to become increasingly abstract. And the vast majority of internet users will never directly interact with anything lower than the websites or the application layer. So, in this diagram, I'll go ahead and start with the "you are here," right? This layer represents all of us currently sitting, in front of our computers listening to this session. If you were to open up Google Chrome and type in mail.google.com, you would be interacting with the application layer, and by hitting the enter button, you're essentially invoking or asking the application layer to invoke a lower layer, which is represented by use case specific protocols like HTTP, FTP, and SMTP. So if we kind of continue with this email example, right, SMTP, which stands for Simple Mail Transfer Protocol, is a universal protocol that enables communications via email over the internet. And since, again, a protocol is just a standard set of instructions, all email applications that use SMTP will have a to line, a from line, a CC line, a subject line, and a body. And this is kind of the reason that you can send an email from your Gmail account to a Hotmail account quickly and efficiently. And so as we move a little bit lower and the level of abstraction increases, what we hit is kind of known as the TCP/IP protocol layer. This layer is much more generic. It's a set of instructions that basically standardizes the way that computers initiate and facilitate communications with each other over a network. And thinking at a very high level, you know, if TCP acts like the technology that makes your phone ring and enables you to communicate with, and IP is essentially your unique phone number, that uniquely identifying address. And beneath all of this lies, you know, the physical infrastructure of the internet, not shown here, but it's there, trust me, in the form of thousands of miles of fiber optic cable running under mountains, oceans, fields, etc. And continuing the phone example, this would represent, right, the physical phone lines. So to sum this slide up, right, the protocol, just a standard set of instructions. The internet is built on protocols, and the interactions between these protocols on the various layers is what allows the internet to function as we currently know it. So now that we kind of have a better understanding of how the internet and protocols work, sorry about that, let's talk about, you know, what's happened in the last decade that has really kind of enabled this boom of DeFi applications that we've seen in the past year or so. And what has happened is that we have seen the emergence of an internet native financial system. And it all really started in 2008 with the kind of the first iterations with Bitcoin and the first iterations of blockchain. And so Bitcoin is really good at tracking the ownership and total supply of one asset, right? Bitcoin, which it does exceedingly well. It acts as a system of account or a digital ledger for that one asset. So naturally, once the movement caught on, there was a flurry of activity to develop more robust blockchains and deploy more internet native assets. The problem is that back then, in order to deploy an asset like Bitcoin, you needed to develop your own blockchain network because Bitcoin's protocols were not designed to support really any other assets besides Bitcoin. And this was a pretty huge barrier to entry. So enter Ethereum around 2015, 2016. And what Ethereum managed to accomplish was the deployment of a blockchain network that was robust enough to support multiple different types of digital assets. And so a critical piece of this development of asset standards, a critical piece of this was the development of asset standards known as ERC20 for fungible tokens and ERC721 for non-fungible tokens. And these standards essentially set forth the minimum requirements that digital assets must have in order to be successfully deployed on the Ethereum network. And kind of a second, you know, watershed innovation that Ethereum brought to the forefront are smart contracts. And a smart contract is just code that sits on the Ethereum network and executes when certain requirements are fulfilled. So now we have the Ethereum blockchain network sitting on top of the existing infrastructure of the internet, who supports a standard framework for building and deploying digital assets. So it did not take long for the development community to realize that, hey, you know, we can start taking chunks of the existing financial services industry, automating the business logic of those services through code, and deploying that code in the form of a smart contract onto Ethereum's network. And this is kind of where the term decentralized finance begins, right? Because where there was once an institution acting as a third-party mediator to these financial transactions, we now simply have code. And so if we think about how the interoperability that ERC standards gave to tokens, combined with the standardization of these finance protocols in the form of smart contracts deployed on the Ethereum blockchain ledger, we basically have come up with money Legos. And what this concept and this term is really saying is that you are essentially able to take these individual financial protocols, whether it's a savings account, a lending account, an exchange account, and you can connect them and stack them on top of one another and kind of come up with what amount to be extremely complex and potentially lucrative trading strategies with little to no friction between these transactions because everything is operating interchangeably. So kind of what we've ended up with is a new layer of internet infrastructure that resembles the use case specific protocols that I described in the previous slide, right? HTTP, FTP, SMTP. The finance protocols sit on top of asset standards, which sit on top of the blockchain, which ultimately sits on top of the internet, the DeFi stack, if you will. So to kind of bring everything that we've talked about kind of in the past two slides full circle, the rise of DeFi and an internet native financial system has really added a new dimension to the internet. The internet, as we know it, is kind of referred to as the internet of content because it's hyper efficient at taking requests from users, relaying those requests to a central server or database, copying the output and returning the output to the user. But it's also limited in the type of content and data it can handle. And that content lends itself to being copied and consumed on a mass scale, right? The point of putting out a TikTok video is that it is consumed by as large an audience as possible. So the internet of content, very good at copying and distributing, but it can't preserve the transactional scarceness required to truly provide financial services. This is why banks and other financial intermediaries have historically been required to facilitate these types of transactions. So blockchains, asset standards, finance protocols, essentially the DeFi ecosystem has shown that it is now possible to preserve transactional scarceness using the internet, and therefore creating what some are calling the internet of value. And because this new internet of value sits on top of the existing internet infrastructure, it inherits a lot of the attributes of the internet of content. It's global, it's public, it's on 24/7, and it's permissionless. And this is so important, right? Because of what Kyle mentioned earlier, is it really expands the opportunity for those who have traditionally gone without even the most basic financial services to have access to them now by merely having an internet connection. So over the next few slides, Kyle and I are going to talk through, the various services that exist currently in the DeFi ecosystem. The first one I'll touch on is a basic lending and borrowing protocol, and these were some of the first movers in the space. It would be, analogous to having a checking or a savings account at your local bank, right? You open up an account, you deposit funds into that account, and behind the scenes, the bank lends those funds out, earns revenue on interest payments, and a fraction of that eventually makes it back to you in the form of an APY interest rate. Pretty simple. And the decentralized parallel is also just as simple. And pictorially, on this slide, it's almost identical. But there are a few caveats, right, that really speak to, again, what is happening under the hood. So the first is, you're not really opening up an account with a protocol, right? That responsibility kind of falls on the wallet, and the wallet is protocol agnostic. So instead of having to open up an account with Fifth Third, open up an account with Huntington, have 5 different usernames, have 5 different passwords, you have one wallet that you can basically plug into each of these protocols, and seamlessly transact the various assets that they generate. And second, when you are depositing an asset, you are essentially contributing to a large pool of assets that is held by the protocol in a wallet, held by a wallet that is owned by the smart contract protocol. And in return, you are basically given what is essentially an IOU token that represents the value of the underlying asset that you contributed plus whatever the stated interest rate is. And what is really interesting is that IOU token is actually in and of itself an ERC token, which has value, which can then be moved and transferred to other protocols to continue to earn value. And this is kind of, starting to see how yield farming comes into play. And on the borrowing side, users of the protocol are able to borrow funds directly from this pool of assets. However, in order to protect liquidity, loans are generally expected to be over-collateralized. And this is because this is truly peer-to-peer lending, right? There are no KYC compliance regulations. There are no credit checks. There really is no identity verification required. You really only need access to a wallet with funds enough to cover the collateral requirements and access to the internet. And so the last thing I'll touch on this slide is this concept of native token rewards, which is applicable really to the DeFi space in general. But most, if not all, DeFi protocols use token incentives to get users to contribute liquidity. And those incentives are generated by the smart contract itself and distributed out to the users periodically. Again, these rewards are ERC tokens, right? With a stated market value that is able to be moved from your wallet to another protocol to earn yield. So now I will flip it over to Kyle, who will kind of go through the decentralized exchange protocols.
Thank you, sir. On the left, we have a traditional exchange. On the right, we have a decentralized exchange, also referred to as a DEX. When we think traditional exchange, think operated by an authority for which users place their funds under their control and use a traditional order book to facilitate trading. In other words, buyers and sellers are matched based upon an order. Think peer-to-peer transaction with an intermediary to facilitate it. We go over to the right side with respect to a decentralized exchange, again, a DEX, open sourced, not owned or operated by a single entity. Liquidity pools are used to facilitate exchange through use of AMMs, which are automated market makers. Think of AMMs as mathematical formulas that determine price without an order book. On a DEX, users maintain control of funds at all times. Instead of peer-to-peer with an intermediary, think peer-to-contract exchange. Last piece here. Talked about the liquidity pool. DEXs generate value for users by incentivizing users to become liquidity providers. So in exchange for depositing your crypto assets into a liquidity pool, the provider generally receives a token that represents their deposit, for which that token can be redeemed for a share of trading fees, valued directly to the liquidity provider. On to slide 12, we'll do a brief example highlighting in the decentralized world how some of the code can almost be thought of in theory as what hedge funds do. So on the left, we have the hedge fund model in a traditional world where investor capital is deployed based on an investment strategy that's monitored and executed by humans that are part of a company. On the right, we have the DeFi parallel where investors can deposit their digital capital into a protocol with community-developed investment strategies to execute and automate a yield opportunity. And I think overall, the point Mark and I are getting across here is things don't look different. The models look the same. We're just replacing central authority with decentralized code. And that's a huge takeaway as we move on. So very brief recap here. We hit on the fact that DeFi to date is not redefining traditional investment vehicles in the finance world. Simply automating traditional investments through code on public blockchain technology that's openly accessible. Second point I want to make is innovation is abundant. Like any technology in the history of technology, right now on a daily basis, the sophistication, user interfaces, and ease of use continues to grow and mature. The pace of innovation is truly rapid. From here, Mark, I think we move on to the DeFi landscape.
Yep. So in the interest of time, we're not going to rehash kind of what the service that these DeFi protocols are providing. Rather, I'll touch on some unique features of it. And the first one that I want to talk about is called Compound. Compound is, again, just a basic lending borrowing protocol. And the interest rates for Compound, which are up on the screen, are all algorithmically generated based on the amount of liquidity in each asset market. So a few things that are unique about Compound is first, both lenders, and so we touched on the incentives component, right? In Compound, both lenders to the protocol and borrowers from the protocol receive a native token award for participating, called Compound Governance Token. By holding Comp, you're basically entitled to a vote equivalent to the amount that you hold through the Compound governance process. A Comp holder can come up with an improvement plan. He will share that plan with the community, and Comp holders can say, cast their vote, yay or nay. Governance proposals for Comp can range from adding a new asset market to the protocol to changing collateral requirements for specific assets. And so lastly, I think the last thing I'll touch on is related to the token as well. The Compound Governance Token has a fixed supply. And interestingly enough, the protocol is designed to automatically allocate a certain percentage of revenues collected through revenue and allocates that to a community reserve or insurance pool that is then controlled by Compound Governance Token holders. So kind of in total, by contributing to and borrowing from Compound Protocol, you are essentially rewarded with a direct say in making changes to the protocol itself. And so next is another interest rate account, which I will touch on very quickly in the interest of time, called Aave. Has about 9.3 billion in total value locked, a market cap of about 5.8 billion. And a couple interesting things about Aave, like Compound, is also a governance token. However, unlike Compound, Aave does not have a fixed supply. And so the protocol is actually designed to use revenue generated from interest payments to buy Aave tokens, burn them, essentially destroying them, creating a deflationary effect on the token. But the most important innovation for Aave is this concept of flash loans. And for a small fee, a flash loan allows you to borrow an unlimited amount of an asset without putting up any collateral, as long as the liquidity is returned within the same block of transactions. Flash loans are technically difficult to pull off and require customized smart contracts to do, so really only savvy traders use them. And now I'll go ahead and flip it back over to Kyle to walk through a couple more examples.
Back on DEX's decentralized exchanges, a few of the key players in the DEX world are Uniswap and SushiSwap. That's on the next slide. There's several other ones. You'll hear Curve Finance, you'll hear Bancor, you'll hear Balancer. The keys to remember on decentralized exchanges are peer-to-contract, user maintains control of funds, and incentives for providing liquidity. Want to go read something interesting about Uniswap, go read about their enablement and their version 3 of concentrated liquidity positions. Very interesting stuff, very strong innovation. See, the total value locked in Uniswap is 5.7 billion. The market cap is 14.8 billion. Go to the SushiSwap slide. Very similar fundamentals to Uniswap, slightly different fee structure, additional yield farming capabilities, and obviously different tokenomics related to the actual token. You can see 3.3 billion in TVL and 2 billion in market cap for Sushi. All right, on to slide 19. You're in finance. We used that hedge fund example a little bit earlier. This is where it's going to play. To give one current day parallel, we all have a friend or are that person that actively goes on nerdwallet.com to identify the best credit card sales, checking accounts, and savings accounts. That person then manually moves around their USD into various accounts to seek out yield. Good for them, you know, they make a quick buck. Well, welcome to DeFi, welcome to Wi-Fi, the acronym for Yearn. It's automatically done for us through Yearn's earn feature. And if we just very briefly kind of walk that through as an example, a user can deposit a stable coin into an earn pool. Yearn programmatically deposits that stable coin in one of 3 lending protocols, Aave and Comp that Mark just hit on, and DYDX. Yearn will then withdraw from one of the protocols and deposit into another to maximize the yield rates between protocols. As a result, the user, us, receives optimal yield. In short, we're talking automated yield optimizer. Yearn also has vault strategies that are community developed DeFi strategies that attempt to maximize the yield through more complex methods. There's a lot there, a lot to unpack there, but we'll leave that for you to explore on your own. Next up, time for us to do a step-by-step tutorial. Let's talk about how we put our hard-earned dollars into DeFi. Mark, kick us off.
Yes, truly how to DeFi your bank account, right, Kyle? So step one, and a lot of this is going to look and feel similar to what everyone experiences going through their financial institutions. So remember, it's very important to understand the first couple of slides we walked through, what's going on underneath the hood is what's most important. So step one, you're going to download Coinbase application, Coinbase wallet, and you're going to link your wallet to the Coinbase exchange application. It's important though to remember that exchanges like Coinbase, they're not truly decentralized finance applications. Yeah, it's a publicly traded company. And I think this has helped a lot of people overcome their hesitancy into stepping into the digital space. But for many though, this is kind of where their exposure stops. They'll buy coins on Coinbase and they'll sit on that exchange. So after you have purchased your digital assets on the Coinbase exchange, the next step is to then start interacting with DeFi applications. In order to do that, you need to transfer your assets to a wallet. So Coinbase provides a self-custody wallet service as well, which you can send your assets to through linking your Coinbase exchange account. And it's important to kind of note the distinction between Coinbase, the exchange, and Coinbase, the wallet, right? If you purchase assets on Coinbase, the exchange, they are held in Coinbase's custody. If you purchase assets on the Coinbase exchange and then send them to your Coinbase wallet, those assets are then in your custody. So now I'll flip back to Kyle to take us through the next few steps to DeFi your bank account.
Okay, so on slide 23, we're at a point where we now have our wallet set up and it's funded with digital assets. We're moving into the series of step 2 items, we'll call them. We want both our phone and computer present and in front of us as we do this. We're going to go to aave.com using your computer. You're going to click connect in the upper right-hand corner as shown on this screenshot here. Moving to slide 24. Once you click connect, we're going to see this pop-up show up where we have this red circle on the Coinbase wallet. From there, you want to click that Coinbase wallet. Moving to slide 25, what happens after you do that? On your computer, after you click Coinbase wallet, a QR code should appear. It's sitting right in front of the middle of the screen. Now you're going to grab your cell phone, open your Coinbase wallet, and click the upper right-hand corner as highlighted on that far right screenshot right there. Take your cell phone, hover over the QR code on your computer screen. At this point, Aave and your Coinbase wallet should nearly instantly connect. Go to slide 26. We'll call these our step 3 series. In the upper right-hand corner, if everything worked, you should see your connection from Aave to your Coinbase wallet. From here, what we want to do, if you click deposit on that top right toolbar, which we have highlighted in that red box, we should be able to see all the digital assets we're holding in our Coinbase wallet. They will appear on the Aave protocol after you click that deposit button on the top tool. So what you can see here, we had a measly $90 in USDC and a measly $15 in Ethereum in our Coinbase wallet. That is all now depositable to Aave. From there, what we're going to do is click the asset we want to deposit. You can see the yield rates on the far right in the red box. We're going to click deposit. What you need to be aware of here is that you need to have Ethereum in your wallet because that's how we pay transaction fees. Yes. So we just clicked USDC in the Aave protocol within the deposit section. That generates this little screenshot we have on the bottom right-hand corner. All you want to do there is click continue. If we move to slide 27, we're in the home stretch of our steps here. Get an approval that pops up in the Aave protocol. Click approve. It's going to trigger an additional approval on your Coinbase wallet. Grab your phone, click approve. From there, you have one final click. Click that deposit button. Bingo. We have our tokens deposited to Aave. So last piece to understand with Aave, A tokens are received as IOUs that are redeemable at any time. In this instance, we refer to them as AUSDC. The My Dashboard feature on the top of the Aave toolbar will show you your yield that you're earning. And we won't do this today, but just understand that the A tokens you receive, if you wanted to conduct a more complex yield strategy, you could deposit those into other protocols to generate additional returns. So on to slide 28. A couple other key points. Omer will cue you up here in a minute or two. Couple key points. Like any finance solution out there, there are risks. It's key for anybody to understand risks. It's key to do your own research, and it's key to understand the landscape. You've probably seen in the news, there are hacks of smart contracts and there are exploits. The space is still young. Three we're going to cover right here are slippage. Just think of slippage as occurring on decentralized exchanges where you're trying to fill an order, there isn't enough liquidity in the pool, you want to fill your buy at 100, but there aren't enough tokens in the pool to do it. So the next price that becomes available is 102 instead of 100. Light loss there. Currently being worked on, Uniswap is doing some fascinating stuff there too. Impermanent loss. Another tough concept, kind of heavily discussed in the community. Depending on the digital asset contributed to a liquidity pool, the chance exists for yield earned to not exceed the asset contribution should price volatility be experienced. Using stable coins minimizes this risk as they're pegged to the dollar. The risk is obviously higher with crypto assets that have more price volatility. Last but not least, need to understand gas fees and put that into your overall DeFi strategy. At the end of the day, just as we think about tax impacts on our profits, we need to think about the gas cost of conducting transactions. All right, last but not least, a minute left here. DeFi dreaming, big four thoughts here. The Gen Zs and millennials love this stuff. The space is innovating on a daily basis. Within your organization, there is probably someone who is following this stuff on a daily basis. Consider anointing them to learn and update your teams. Give them that official task. If you haven't already begun to do so, research the impacts of tokenizing your assets on your balance sheet, along with the supply chain and internal performance benefits associated with using enterprise blockchain. DeFi is certainly reimagining the types of assets that can earn yield. Third, explore smart contract insurance. We expect DeFi insurance product to grow. That will protect you from some of the risks we called out earlier. And last but not least, the EY Digital Assets team is always happy to talk. We love to educate. Feel free to reach out at any time. All right, the moment we've all been waiting for. Omer, the floor is yours.
Thanks, Carl. Thank you, Mark. That was amazing. Let me just quickly share my screen. So if you can, Kyle, please stop sharing. Thank you. So here we go. So as we understand, smart contracts are quite a substantial pieces in this DeFi puzzle. And I would like to close this session with a quick sneak peek under the hood of a more, I would say, technical perspective in order to better understand how smart contracts work. The smart contract testing studio that you see here is basically a safe environment to easily interact with smart contracts. And we believe in EY that there's a need for a tool that anyone, and not necessarily developers, can use in order to interact directly with those smart contracts and better understand the underlying logic, and doing so in a risk-free environment. That way, DeFi users and developers can achieve greater confidence and trust in these complex decentralized protocols that a few of them have been demoed today by Mark and Kyle. So again, the testing studio is a codeless environment that enables you to interact with smart contracts. Actually, no setup is needed. You don't need to use any wallet on external application. Just log into the tool and start creating your testing scenarios. I will be demoing a mainnet simulation of a quite simple DeFi strategy that demonstrates an interaction with 4 different smart contracts. So my simulation is based, it will be done on behalf of this O3 address, just for simplicity. And I would like to start with making sure that I have enough funds in this address. And I've created this simulation before and make sure it executed well. And by the way, when I speak about mainnet simulation, what's going on in the engine that this tool is running, that we bring in a full snapshot of the state of the mainnet, which is all the balances and all transaction history. And the simulation is created in this sandbox, but is based on top of the all the information of the state of the mainnet. So we started this journey with funding our address with a significant amount of ETH to start this process. Then we will we'll continue by defining the smart contracts that we would like to work with. So for example, the first smart contract is the Uniswap router. As opposed to the Uniswap token, the router is the smart contract that the protocol or the application interacts with when we would like to swap different assets like ETH or ERC20 tokens. Next step is to define the DAI token smart contract. We actually can, by the way, when you click here download contract from Etherscan, you can drop in the address of the mainnet address of the smart contract, and the code, the bytecode and the Solidity code will be fetched into the tool for easier user experience. So first thing, I would like to check the balance of my address, the DAI balance of my address, and we can see that it's empty. There are no DAI in that address, but we already have 100 ETH in that address. So once I call the swap function in the Uniswap router, I won't go too much into details now, but that went successfully. And what I expect to see that now I actually have the DAI that I swapped for in my address. Next step will be to create or to define the Aave lending pool smart contract. That's the smart contract that will allow us to deposit the funds and receive that A token that we were talking about, which is the interest-bearing token that we hold as long as we would like to earn that interest. Next step is to create something that we need as part of this technical or more maybe financial process, since we would like that the Aave smart contract will basically take or withdraw funds from our address, the O3 address. We need to give it an allowance. We basically use the approve function of the ERC20 token to allow the smart contract of the Aave smart contract to withdraw the funds from our O3 address. After that, I'm actually adding the last smart contract to this piece, and that's the smart contract of the Aave DAI token. And now the next step is to just to make sure that the balance is empty. We see that we have no A token balances in our address. And last step is basically calling the deposit function of the Aave protocol. That went successfully because now we have the A tokens, the interest-bearing tokens in our address. So this was basically, it's a quite a simple strategy from a DeFi perspective, and a very fast, quick run of how you can use the testing studio to interact directly with smart contracts. It's a great way for developers and people and other folks from the space that are not necessarily tech savvy to interact directly with the smart contract and test the transaction before they're deployed to the mainnet. You can have some estimation of the gas fees, and just keep in mind that if a transaction fails on the mainnet, you will lose your gas fees. So this is a great way to feel more comfortable with testing different transactions before they're actually executed. And and if you would like to create a more advanced strategy, you can create some kind of an hybrid creature where you take smart contracts that already deployed to the mainnet, but add to this to the tool smart contracts that you develop as a strategy, and you can test this hybrid creature that is between mainnet transaction and actually and strategy smart contract that wasn't deployed yet to the mainnet. So Kyle, Mark, thank you guys for this great session. And by the way, if anyone would like to try the testing studio, it's still on beta phase, but feel free to log into blockchain.com and fill out this form on the enterprise page. We will give you an early bird access to the tool. Thank you, everybody. And I guess back to you, Wasim.
Yep. Thank you, Omer. Thanks, everyone.
Thank you, gents. All right, time for some more blog talk with Matt, Megan, and Guido. Matt, the mic is yours.
Thank you very much. What a great conversation. Good to know that I actually have a DeFi beard. I did not realize that. And I will now explain that to my mom and others that ask me what's going on with my beard. So great conversation. I think did a great job. The team there, Kyle, Mark, and Omer did a great job of explaining something that I think is talked about quite a bit recently, but perhaps not fully understood, and really taking that to the next level. So certainly appreciate that. Mark made some important points there at the beginning relative to sort of why this is important to be grounded in this, and reference to the unbanked and underbanked population globally, which is, depending on how you count it, between 1 and 1.7 billion people, and really helping to, I think, prove the point that with access to the internet, anyone will have access to financial services in the future, which I think is incredibly impactful. Megan, maybe I can turn to you first for some reactions on DeFi in general.
Yes, so I thought it was a great overview of some of the most popular tools in DeFi on the market right now. I think that it's sometimes just coming from a United States perspective, creative financial products sometimes make us nervous, but the potential for inclusive financial access to those that don't have it right now is huge. I think that, particularly just because it's tax time recently, a lot of us just filed taxes. Some of this stuff is what makes accountants and tax preparers' heads absolutely explode. And so going through and having a super detailed and understanding of these protocols and how the assets transform as they move through smart contracts, is a key, key value proposition in any sort of like tax preparer's practice. There was an SEC commissioner that said maybe 2 years ago that they're not able to create laws around this stuff because we're still developing them, and any sort of change in code and smart contracts changes the nature of the assets. So it's important to keep a close pulse on the newest developments.
That is a wonderful plug too, Megan, for the next session, which is going to go into tax implications and tax technology surrounding the distributed ledger and blockchain space in general. Guido, how about yourself? Any reactions to DeFi here?
Yeah, I mean, I think it was a great presentation, sort of giving this, broad overview. I think one of the things that was mentioned is the very interesting incentive structure that's been put in place by this platform to attract users. And, us as a firm, we have actually worked with some of the platforms that have been mentioned, is sort of thinking about, okay, when I have to launch this new financial product and bootstrap the network, how do I attract, people to provide liquidity or people to provide transactions, and having a native token and sort of having distribution mechanism for the token to, again, reward basically early users has been really a key winning feature for many of the DeFi platforms that have been mentioned. And I think that that's something that has been pretty unique compared to other type of blockchain application where we have not seen that level of quick adoption that we have all witnessed in DeFi for the last 4 months.
Yeah, I think that's great. Yeah, it was. I think it was on slide 10 when there was some representations of sort of a DeFi and pre-DeFi or current state, I guess, and then DeFi, and the simplicity of looking at some of those models, and yet a few things change that are extremely dramatic, right? Meaning an intermediary becoming a smart contract. There are a lot of large intermediaries today, which are very significant entities, which have people, infrastructure, operations, and costs associated with that and friction. But thinking about how this becomes truly a DeFi enabled environment where that could exist entirely on a smart contract is really incredible to think about. And if you, the way I look at this really is, I think we are in this, we're probably 10, 15 years in on this overall, but we are, I think, beginning what is going to be a very dramatic rewrite of the financial services stack into this DeFi world that we just explored. Do either of you, Megan, I want to point this to you because you kind of hit on it a little bit with the tax point, but do you think we get to a point in the future where regulations, as we know them today, right? They come out, they're in words and then interpreted by companies that then put in place processes and controls and compliance activities. Do you think we get to a point in the future where regulations exist within the protocols and they make their way to protocols and they define the way that the way DeFi works?
Yeah, I certainly think that that is the future. I think that there is a lot of heavy infrastructure, particularly in securities around moving around assets, and we're already seeing some of the largest firms in the space look to optimize. And to me, the technology is there. It's just a matter of willpower from the regulators. All
right. Awesome. Well, thank you all for your time. I do want to, as I mentioned, tax is up next. It's going to be a great conversation. At 1:55 Eastern, we have New Economy, Old Valuations, with David Traynor. Very much looking forward to that. And thank you. We'll see you back to you.